It is very important when you're thinking about these issues to not confuse fixed income credit with equity. And you do need to think about the two separately. And a lot of people, when they talk about these, they talk about it as if it's one big thing. But actually, if you're thinking about portfolios and you're thinking about how you examine your portfolios, then we've started integrating and separating out ESG risks on all the entities that we rate. And what that is telling us is that on the fixed income credit side, governance and social risks are far more important for credit ratings than environment is. And that's because environment is easier to see and measure in the credit impact timeframes that we're looking at. And that's the difference between fixed income and equities. You've got very different timeframes coming into play. And so that's very important. When you look at the change in regulation, you look at the change in laws that have gone on over the years, it definitely helps, but what it does is it kind of frames the issue, and it doesn't really tackle the issue. It provides a framework in which to look at these issues and to examine them. And it's interesting to hear the wide range of 2100 certainty over the degree changes, because certainly the trajectory that we're on at the moment is somewhere around about 4.5–5%. And actually for a lot of developed market countries where they made gains initially by essentially outsourcing their carbon emissions to other countries, it's becoming increasingly a lot harder. You see that in places like Germany in Europe. And so I think in terms of challenges, then when you look at the bigger picture and you look at this longer term framework, the thing that a lot of people tend to ignore is that we have suffered essentially from hydrocarbon addiction for nearly 100 years. And what we're saying is we need to wean ourselves off that addiction in a very short period of time. And that's not easy. If you look at the way that the frameworks are set up, if you look where government revenues come from in terms of taxation on oil, taxation on all sorts of different manufacturing processes that actually rely on hydrocarbons, there's not a huge political incentive to do anything about this quickly. Because what you do is you increase costs for your population and you reduce tax revenues at the same time. If you're a politician, that gets you fired. So it's a one-term event. And what you see is you see a lot of talk about doing stuff. You see regulatory changes, but it doesn't really bite. And kind of everybody is waiting, I think, to see whether it makes a difference. But personally, my own view on how you actually get somewhere on this is it requires a mindset change and it requires sacrifices. I think regulation will play a big part going forwards, and I suspect it will come more from non-developed countries. If you look at what China is doing, then China, the securities regulator there, plus the Department of Environment for the Chinese government, they've introduced legislation that from 2020, every listed entity within the Chinese domestic network will have to disclose ESG metrics. And anybody issuing a bond domestically will also have to disclose ESG. And there's a standardized form for that. So in a sense, they are moving faster and further ahead than the developed markets. But they need to. And one of the problems you have is it's very easy for us in the developed market, where we've benefited hugely from internationalization, from globalization, from outsourcing our carbon production into other places and getting cheap goods in return, to then say, well, actually, you emerging economies which are thriving and developing very fast with extremely large populations, you shouldn't aspire to this. You should aspire to something different. And actually, that's really difficult. But I think that there is some very positive change going on there. I mean, I think China will definitely lead the way. One of the key opportunities, and it's also a risk in terms of a global risk, is the fact that infrastructure remains fairly undeveloped relative to developed markets. And therefore, there's a lot of opportunity for investment in that. But then there is also a lot of risk that you look at the energy infrastructure in China, for instance. By 2050, coal-fired production in China will still be over 60% of the generation pool. And that's a lot compared to anywhere else in the world. And it's also on a trajectory that is gradually growing as well. And so, you know, that's a very big risk from a climate change perspective. The opportunity to invest in clean coal, maybe to change the way in which things happen, is clearly there. I mean, infrastructure-wise, a lot of the infrastructure that is getting built out in the emerging economies is, again, geared towards hydrocarbon-fueled vehicles moving goods around. And you have to question whether you will get a shift that moves from that to autonomous vehicles, and that becomes part of the infrastructure build-out. Potentially in somewhere like China you might do. It's very, very difficult to see that happening in somewhere like India. Very, very difficult. I mean, there's some interesting applications that you could use for things like public blockchain disclosures by companies in this area, where if you're putting disclosure around this type of thing into public blockchain, then essentially you've got a permanent public record of what you've said about this. And it becomes very, very difficult for companies then to turn around and say, well, actually, no, we didn't say that, or, oh, I misspoke. I think in terms of a path and a journey, you're kind of at the gate, having opened the door. What can the financial sector do? I think in terms of trying to detect this type of thing, it's really difficult. It's the equivalent of sort of fraudulent behavior and that type of activity. But if there is more demand for transparent data disclosure, then actually the financial community can play a big part in saying, well, actually, you know, I'm not going to invest in you if you don't disclose this, and I want full and proper disclosure on it. And so I think there's an opportunity there. I think we're probably still at relatively early stages in that, but there's certainly a lot of momentum building for more sort of action and lobbying, I think, on behalf of financial investors, particularly bond investors. I think that there's quite a momentum now for bond investors to get more involved in engagement with entities.